Hello everyone, investment scams rampant. Please vigilant and discerning. Do not trust information from unknown sources. Please make sure to recognize 2 official Capital Securities community, Facebook, Capital Securities, YouTube, Capital Wealth Insights.
All right, good evening to all the viewers and friends of QNE. Hello everyone. I'm very happy to be here. Today is November 4th, and it's Tuesday again. Let's take a look at which 2 topics we'll be sharing with you today, as well as some updates. First, let's review the possibilities for the market to go up or down. Because actually, the index has been fluctuating at a relatively high level recently, so we want to take everyone through an analysis to see if maybe market institutions, investors, or the data itself show any potential for the market to go up or down in the future. Or, if such a possibility exists, what are the reasons behind it? We'll explore these one by one with everyone. As for the second topic, although this information started coming out around last weekend, it's about the meeting between Xi and Biden. After their meeting, they reached some mutual understandings. So, we'll take a closer look to examine exactly what kinds of agreements or actions were made during that meeting. So, what commitments did each side make? And in the future, how should we gradually assess whether China and the US will actually cooperate more, or if there will be more behind-the-scenes rivalry? Alright, first, let's take a look. Hello to all our online viewers, Anna, Ernest, My Daisy, and Zayameo. Alice, good evening, everyone. Okay, so first, let's take a look at this news. Actually, this is about to happen in the next couple of days. But as we can see, the US Supreme Court. If the Supreme Court makes an unfavorable ruling regarding Trump's authority to impose tariffs, actually, this decision might not come that quickly. Here, they're just talking about the possible outcome first. The US government might be forced to refund more than $80 billion in tariffs that have already been collected. If it goes until the end of the year, the total amount of refunds could exceed $140 billion. So what about the judges? Well, coming up on November 5th, the judges are preparing to address the issue of Trump previously relying on the International Emergency Economic Powers Act back in April to hold a hearing, this kind of procedure. Okay, so here it mentions that half of the effective US tariff rates are collected based on this act. If, in the future, a ruling says that this is. If it's found to be partially or completely invalid, then the Trump administration or his team might consider using other provisions, like Section 232 or 301, to achieve the same goal and actions of imposing tariffs. However, if he imposes tariffs based on the IEEPA, there's a chance, at least for part of it, that the judge might overturn it. The likelihood of this happening is about 68%, so more than half. So this is an important point to watch in the future. And we also know that actually Trump, he really cares about saving face, and he genuinely wants to implement his strategy of imposing tariffs on various countries. Or, in other words, he hopes to put into action his plan to bring manufacturing back to the United States. So, in fact, tariffs have always been a part of this mindset and belief. If the Supreme Court really makes such a ruling, will they come up with a new kind of action in response? This new action would be an uncertainty for the stock market. No one knows what he might do. Of course, back in April, it was the first time people felt that his tariffs seemed very broad and widespread, and the rates were quite high. That kind of upended everyone's expectations. That's why the stock market panic was more intense back then. This time, it might not be as severe, but it's still an uncertainty, so that's one of the variables. Of course, in the future, as this situation develops, we'll keep everyone updated. Alright, let's take a look at SK Hynix's stock price, which we mentioned yesterday. Since it's in the memory industry, there was a period of shortage before, so prices kept going up. This year, its stock has soared by 240%. We'll take a look at some related companies in a bit, like Micron's chart. Here, let's also mention that the Korean Stock Exchange has unusually issued a warning to investors, basically hinting that this stock might be overheated in the short term. Now, what does overheated mean? It doesn't mean the stock won't go up in the future, but if investors rush in right now, there's a higher risk of hitting a pullback or a drop in the short term. Fortunately, the Korean Stock Exchange explained that they issued this investment caution notice because, as an official institution, they don't want investors to get hurt unnecessarily. So, they mentioned that early this Tuesday morning, the stock once dropped by 5.3%. This 5.3% drop is actually quite significant compared to the past 3 weeks. Last week, in particular, saw a noticeable decline. The exchange is acting out of goodwill to protect investors in this situation, giving everyone a risk warning. Since the beginning of this year, SK hynix has been considered one of the top 3 global leaders in memory chips. The demand for memory has surged due to the aggressive expansion of data centers. With computing power continuously increasing, it naturally goes hand in hand with the demand for high bandwidth memory. The market is very hot right now, and the profit margins are quite high for the industry and manufacturers. As a result, these companies might shift their production capacity away from more traditional products like DDR4 or DDR5, and instead focus on memory types that offer better profits, because selling those brings in more money. So, as a result, they gradually phase out or reduce the production capacity of DDR4. This leads to a continued shortage in the industry, which in turn causes prices to rise. When prices go up, everyone becomes even more eager to buy this type of memory to replenish their stock. That leads to further price increases. So that's why some analysts or institutions are calling this memory cycle a super cycle. In fact, I've even noticed some news reports, for example, about domestic memory companies. Some of them are considered authoritative leaders in the industry. One of them mentioned that, well, in his 20 or 30 years in this industry, he has never seen such a level of excitement and prosperity. No matter the product type or model, all kinds of memory products are experiencing a significant surge. So, this situation is quite rare in the short term, as it hasn't happened before. Everyone should also be aware that this kind of boom might last for a while, but in the stock market, since everyone knows it's driven by this excitement, stock valuations in the short term are relatively high. The valuation levels have already risen, so everyone should pay attention to the related risks. Alright, let's take another look here. Micron Technology is also considered a leading memory company in the US, and its stock price has soared. So, will this rally in chip stocks continue? Here, there's a question mark. This is quoting an author from Barron's, Adam Ha. Clark, he said that yesterday we saw its pre-market price was up by more than 4%, right? So, is there actually any obvious positive news or any particular reason for this? The reason is that its Korean competitor, SK hynix, which we just mentioned, is seeing strong demand. Even though the two are competitors, both in the drum market, they might have similar or even the same products. But because the overall industry trend and demand are so strong, once one of the top 3 leading companies notices this, like we can see with the surge in demand for DRAM and storage hardware, this spike in demand isn't just limited to one company. There will be a lot of strong, even excessive, orders for many companies, and Micron could also benefit from this. So, as we can see, by last Friday's market close, Micron Technology's stock price has more than doubled in the past 3 months. Let's take a look at its chart performance. So, over the past 3 months, from early November, which is roughly early August, the stock price was around 100 or 110. Now we can see it's recently reached about 220, which is basically a doubling. This reflects the surging demand and hype around AI and artificial intelligence. Plus, the industry cycle for integrated production tools has reversed. Maybe 6 months or a year ago, the excitement wasn't this high, but now, as everyone has noticed, with prices continuously being raised, both the industry's heat and profits have gone up. That's why the whole industry is moving again, and that's also why the stock price has reacted this way. Alright, let's take another look. Now here, we're mentioning its connection to this. As for American companies, like Micron, their stock price has gone up, and this is related to SK hynix. Especially with SK hynix, they've showcased plans for their next generation products, including several customized AI memory chips. These are designed to work with, for example, the systems we just mentioned in the US, like those related to NVIDIA. And as for related AI companies, because they are continuously building infrastructure, whether it's for data centers or other needs, many giants like Microsoft and Amazon are buying things from them, whether it's computing power or GPUs. So the entire industry sees this as positive news. Even competitors have seen their stock prices go up, and SK Hynix even mentioned this as well. In the coming year or two, or even just looking at the next year, if we take a conservative view, all the memory chip manufacturers' production capacity has already been sold out. Everything they can produce has already been ordered, or is in the process of being prepared for delivery after receiving orders. All of it has already been used up, so they basically have a few options. First, they could increase their production capacity, but building new factories or expanding existing ones isn't something that can be done quickly. So, the imbalance in the supply chain for these products still exists. The second option, besides increasing capacity, is that they might adjust their pricing first. But as for this demand, maybe they'll have their clients evaluate it to see if it's really necessary. You know, some clients might actually be overbooking, placing excessive or duplicate orders. Even though they already have enough, they might order a bit more just to be safe, to build up inventory as a precaution in case there's a shortage. Alright, to add on, because of the surge in demand for artificial intelligence, the production capacity of the departments making legacy drum chips is limited. As we just mentioned, the production capacity for things like double data rate 4 will gradually be taken over or shifted to double data rate 5. Or to HBM, high bandwidth memory, and other higher margin products like that. Alright, now let's take a look at Capital Group CEO Mike Gidling. He attended a meeting like this on Tuesday. He said that the profit performance for the quarter was strong, just like last week when many tech giants reported earnings that beat expectations. So, in this kind of situation, the level of profit performance being shown is quite good. However, this also leads to a challenge in terms of valuation. Sorry, I mean both valuation and assessment can pose a challenge. For example, legendary investor Charlie Munger once mentioned why investing can be difficult, or rather, there are still some difficulties, even if you know this company is a good one, with strong profitability and growth potential. However, because so many institutions and investors are also aware of this fact. After everyone buys in, the stock price goes up. Once it rises, you have to keep watching or estimating whether there's still room for it to go higher, or how long this momentum can last in the future. This is actually a rather difficult thing to do. People need more information or wisdom to make a judgment. So, regarding the current valuation level, as you can see, he already mentioned it. He was asked whether the current valuation is actually cheap or not. Is it reasonable? Or is it fully valued? Most people would say that right now we're somewhere between reasonable and fully valued. For example, if it goes beyond fully valued, then it's leaning toward being overheated, right? But as long as it's still between reasonable and fully valued, you could say it's not too bad. So it's not very cheap, and the situation isn't slow either, but it's still in the middle range. That means there could be some fluctuations or corrections. But he also added that there won't be many people, because what he's talking about is more of a market consensus, or the general view in the investment community. Generally speaking, people are saying that not many would call the current situation cheap or reasonable, so that means it's above reasonable. Now let's take a look. If we look at the data, as we just saw, there is this kind of situation. The CEO of this investment firm told us about this, so let's see. If we just look at the data alone, does it match what he said? Alright, the S&P 500 currently has a forward P/E ratio of 23. If we look at the 5-year average, it's about 20. I did some calculations myself. If we're talking about what was just mentioned, that it's somewhat reasonable and fully valued, meaning there's room for volatility or a correction. Generally speaking, a correction is defined as a drop of more than 10%. Alright, so if we do the math, the difference is about 20.7. If the PE ratio of 23 drops by around 10%, that would put us right at the threshold of a correction. Alright, so that would bring us close to the 5-year average of 20 times earnings, which is about 20%. On the other hand, if we look at the Nasdaq 100, its PE ratio is much higher, at 28 times. Here, it's being compared to 2022, when the average was less than 19 times. But in 2022, viewers should also take note because that was a year of aggressive interest rate hikes. That means that many stocks, whether tech or growth stocks, actually saw their prices drop quickly and sharply that year, and the decline was also more widespread. So, when you compare it to 19 times earnings, it seems like the difference is quite significant. However, we also need to consider that for the same year. As for the monetary banking or monetary policy background, it was, relatively speaking, a period of aggressive rate hikes. In other words, the liquidity was quite tight. But this year? Oh, we can already see that there have been consecutive signs of rate cuts. As for whether there will be a cut in December, well, as we mentioned yesterday, it's still not certain. I think, actually, Chairman Powell brought up an important point, and he used a very relatable, everyday example to explain it. He already mentioned it. If the Fed is making decisions, it's like driving in the fog. We can observe certain things, like when you're driving or riding a bike yourself, or even watching a bus driver. If it's pouring rain, like a heavy downpour, right? What usually happens? You drive a bit slower to avoid potential visibility issues, or in case something suddenly darts out, like a bicycle, an electric scooter, or a pedestrian. In these situations, you tend to be a bit more cautious. And that brings us to what we mentioned yesterday. As for the Fed, back in 2020 and 2021, when it came to inflation, their estimates were relatively. We can't really say they were wrong. Calling it a misjudgment would be a bit too harsh, but their estimates did come a bit late. They preferred to wait until things were certain, and even if inflation had already risen, they would use interest rate hikes to try to rein it in. Now, we're facing a similar situation again. Because of the government shutdown, they can't access the usual, more comprehensive employment data that they would normally have when the government is open. The same goes for other shared data, so of course they're going to be more cautious, right? It's like driving in heavy rain. So, whether in December they decide to raise or lower rates, there's another key point to pay attention to, which is related to the recent halt in balance sheet reduction. Normally, stopping the balance sheet reduction would be more favorable for short-term liquidity. It's a relatively loose situation, meaning that on the capital side, it's also somewhat aligned. In other words, it's moving in the same direction as their previous rate cuts. Will it be like having one hand and one foot on the brake, and the other foot on the gas? That's unlikely. You probably won't see such contradictory actions. So, after stopping the balance sheet reduction, they might be able to buy some short-term assets. Whether it's government bonds or other assets, this can make the capital markets more active, and it also helps lower some borrowing costs. Overall, for the economy, this approach is somewhat more positive or supportive. Alright, let's take a look here. If the price-to-earnings ratio really is as high as 28, is there any room for correction? Let's say we use a 10% correction, just like we mentioned earlier. We don't even have to go as far as a 20% correction, which would bring it closer to entering a bull market, a bear market, getting close to a downturn. If it's just a simple P correction, it would be around 25 or so. As for 22, that's under a scenario of aggressive rate hikes, so I think that's a bit too low. The baseline is pretty low. It seems like it's mentioned here that the US economy is slowing down, and the current government is shut down. But as we pointed out, global stock markets have still hit new highs this year despite all that. Concerns about the market being overvalued are only increasing. There's also the CEO of Citadel, Griffin, who mentioned that the market is currently in a bull market, and whether it's at the peak of a bull market or the bottom of a bear market, it's usually less rational. Let's take an example. Back in April this year, when the reciprocal tariffs were first announced. Because the tariffs were really high, and at the time, no one knew what was going to happen. Of course, looking back now, we know that maybe Trump backed down later, or he changed course, delayed, or postponed things. But that's not the point. If you recall the atmosphere then, it probably hasn't fully come back to you. It was panic, right? Some large cap stocks almost hit their daily limit down, didn't they? This happened in Taiwan and the US. Of course, in the US, there isn't a daily limit down, but still some US stocks. The main stock indices were also correcting, and the leading stocks were correcting too. So at that time, the panic really started to spread. People weren't very rational then. But now, of course, we're not in a bear market, right? But it's more like this bull market has been going on for a while and has developed. So people are worried, that we're now in a very deep stage of the bull market. So when we look at the index, let's calculate the ratio and see if it's really like what they say. Alright, so about this summit, Goldman Sachs CEO Solomon also shared his expectations. He said that over the next 12 to 24 months, which is about 1 to 2 years, wow, that's quite a long time frame. He said that the potential pullback rate would probably fall somewhere between a correction and the threshold of entering a bear market. In other words, it likely won't actually become a bear market. He thinks a correction could happen within the next 1 to 2 years, and that's quite a long period, right? We might be able to see it happen next month, or maybe in March, maybe March next year. It's not certain. Anyway, he thinks that's roughly how it will play out, and he believes there's room for a pullback. Okay, so here, let's talk again about investors' attitudes toward US stocks. The belief that the market only goes up and never down seems unshakable. So, the more this is the case, the more cautious we need to be. So, who is one of the most steadfast bulls on Wall Street? Here, there's someone named Yardeni. He's quite well known, whether it's for his strategies or for this. The founder of Yardeni Research has been bullish for a long time. But now he says, it's time to be careful. This is a kind of contrarian warning signal, also known as the so-called differential synergy theory. For example, the origin of this Kaishikuin theory is that, well, today, when people outside of Wall Street in New York, like those who shine shoes for people working outside of Wall Street, even the shoe shine boys start talking to everyone about whether stocks are worth buying, or, to put it another way, maybe a more vivid but not inappropriate example. For example, if there are people who are usually indifferent to the market, almost like monks, and even they start telling us, hey, this stock has really been doing well lately, then maybe we need to be careful about whether things are getting overheated. In other words, when everyone from the top to the bottom is talking about it, it might be a sign. When stocks are about to go up, it's a bit like the previous stock market frenzy in Taiwan. Of course, when everyone is hyping up the stock market, you have to be careful whether a pullback or a drop might be coming. He said that when there are too many people who are bullish, well, this part here, I actually think is more, something worth questioning or at least paying attention to. What do I mean? In the past 6 months, the stock market has pretty much ignored all warnings and kept up a strong upward trend. It was only from April to the end of the month, or maybe until early November, right? So doesn't that actually mean? All these warnings came after the market reached relatively high levels, after it hit new highs. So actually, looking at all these warnings now, they might be, wrong, if we look at it from the perspective of the market hitting new highs, because, what have these 6 people been doing? They've been warning, saying, is it too high? Is it too high? But the market kept hitting new highs. Those warnings were useless, right? If instead of warning, they just went long and encouraged everyone to buy, wouldn't that have made money? So, ignoring the warnings and keeping a strong upward trend all the way, this statement isn't wrong. Then it's said that right now, Chairman Lin is indeed not very certain, so he's being more cautious. We just mentioned driving in the fog or driving in heavy rain, and as for Yardeni, who we just talked about, he's starting to question his own judgment about the market rising at the end of the year, because originally he thought that by the end of the year, it was possible that the S&P index could approach the 7,000 mark. That was his original prediction, but now he's slightly changed his tune. He says it's possible that before the end of the year, it could pull back about 5% from its high. He's basically not as certain as before. He was pretty straightforward about it, saying around 5%, because both sentiment and technical indicators show that the market is overheated. The key question is whether this rally has already gotten ahead of itself and used up its momentum. In other words, yes, the market has been going up recently, but the question is, has it risen too fast and too aggressively, so that the room for a gradual increase has already been used up? After the surge, maybe it's time for the market to take a break. Right now, the market breadth isn't really strong enough, so it would only take a single unexpected event to pull the stock market down from its highs for a bit of a correction. But on the other hand, as we get closer to the holidays, like Thanksgiving, Christmas, or even starting from Halloween, all those common year-end holidays in the US and Europe, People tend to have a more optimistic mindset, and it's not that easy for any sudden negative news to pop up. Yeah, generally speaking, from April to November, it's like the market just keeps going up, and the more you see it rise, the more cautious you start to feel. But it still keeps going up. So why is that? Is it because profits are providing support? Or maybe it's mainly because the big tech giants, whether it's their earnings reports or their optimistic outlooks for the future, are also supporting this kind of rally. Now, let's take a look at what the market sentiment is showing us. We just mentioned whether the market sentiment is really overly optimistic. Let's take a look. What about bullish sentiment? It's already reached a one-year high. This data comes from Investor Intelligence, a research organization, which published it just a few days ago on October 29th. The ratio of bulls to bears has risen to 4.27, meaning that for about every 4 people who are bullish, there's one who is bearish. This ratio has broken past 4, which is historically considered a warning line for overheated sentiment. Let's take a look at what this line chart roughly looks like. The data source here is also from Yardeni, who probably did some organizing, along with Investor Intelligence. This shows the ratio of retail investors who are bullish versus bearish, and right now it's at 4.27. Right. Let's look at this chart. The blue curve here represents the ratio of bearish to bullish sentiment. Right now it's at 4.27, so it's risen to this point. Now, let's take a look at why there are some red areas in the past. So what do some of these situations or the blue areas mean? The red areas, as we just mentioned, represent bear markets. That is, periods when the market has dropped more than 20% from its peak. The last obvious instance of this was back in 2020. Because the US economy went into a full lockdown due to the pandemic, and at the same time, there was an emergency rate cut just the day before, as they tried to rescue the economy from this situation. That's why we saw this kind of panic-driven drop. Alright, and of course, there was also the situation back in 2008 during the financial crisis, which was a very obvious bear market. But in between, there were some pullbacks. The blue areas represent corrections or pullbacks. You could say they were corrections, because the term correction is more precise here. That is, it's generally more than 10% but hasn't reached 20%, so between 10 and 20%. If we look at it, actually, in recent times, there haven't been that many instances where it went above 4. Let's draw a line here to set a boundary. Before that, there really weren't any. After that, maybe because the stock market kept rising, people felt more optimistic. Or maybe it's the ETF craze. Everyone knows ETFs are for long-term investing, right? You buy gradually, a little at a time, and when the market pulls back, you buy more, buy on dips, or just keep buying on a set schedule. So now, it seems the proportion of bullish people has increased. But we've been through this many times before. Right now, we're still just seeing a pullback and some volatility after hitting new highs, right? Even though we've experienced this many times, it's just a matter of when it happens during this period, and whether it's triggered by some unexpected event or a structural factor. What else should we keep an eye on in the future? What's another thing that might make people feel a bit uncertain? So, what about the sales of cardboard boxes in the US? The continued slowdown has further intensified concerns from the outside world about weak retail performance during this year's holiday season, like Thanksgiving and Christmas. According to data released by the industry organization, the American Corrugated Box Association. In the third quarter, the net shipment volume of corrugated boxes dropped to the lowest level for the same period since 2015. That is, the lowest in 10 years. For example, every year around this time, the numbers have continued the sluggish trend seen in the previous quarter. So, several packaging companies that specialize in this kind of business have issued warnings, saying that economic uncertainty is suppressing the willingness of some retailers and consumers to spend and make purchases. Let's take a look at the chart. This chart here shows exactly that. The gray bars represent the most recent quarter's data. So we can see that, indeed, it's quite similar to what it was back in 2015. In the past few quarters, the retail data had been pretty good. Why are we talking about corrugated cardboard boxes? The reason is, when we buy these things, well, when these manufacturers and companies buy these items, it's mainly for packaging and retail sales. But here, I want to highlight an important point. whether it's the impact of tariffs or changes in consumer habits. It's possible that people are shifting their spending from goods to spending on services instead. What does that mean? It means that maybe I won't do as much online shopping anymore, so I don't need as many cardboard boxes. Maybe I also won't go out shopping for physical goods as much, but instead, what do? Maybe I'll go skiing, or dine out at restaurants. Or, for example, I might subscribe to something like Netflix. Streaming platforms, audio or video, these kinds of service-based consumption. All of these are related to technology or to spending on service content, rather than simply buying physical goods. This is something we've seen in recent years. In the US or Europe, for example, this is a more common shift in consumer habits or mindset. In other words, people don't necessarily need so many physical goods anymore. Instead, they choose to spend on things that support their emotional value. Services like these, for example, I think watching a movie is great. You get to relax for a couple of hours and really immerse yourself in it. Or you can watch Netflix at home, which is also nice. For leisure, you might have a coffee or enjoy a small snack or dessert, just to savor that cozy, joyful time, or maybe even get some inspiration from it. Alright, let's move on to today's second topic. What else does the fact sheet from the joyful meeting mention? It says here that China's retaliation against American semiconductor manufacturers and other large US companies will come to an end. Some of the things we might have talked about yesterday, so we won't go over those again today. In addition, China will also open its market to US soybeans and other agricultural exports, meaning it will do so in its own way. Chinese companies, including state-owned enterprises, will also purchase these major US agricultural products. Additionally, China will take the following actions. Finally, it will suspend the broad global restrictions on rare earth exports that were previously imposed. This previously caused a market pullback, right? Okay. Next, he said the main focus is on soybeans. Why? Because he knows that if China buys such a large amount of soybeans, it can help appease and reassure, since Trump needs to answer to those agricultural representatives and such. He needs to answer to the voters in the soybean-growing regions. Also, both sides hope that this will be, relatively speaking. It's not so much about bringing more positive news, but rather, as I saw a great description, it's about reducing some of the negative factors. If we can ease this tense, confrontational atmosphere, that alone will help stabilize the market. Now, let's take a look at some key traditional chipmakers, for example, on semiconductor. For example, these can be shipped to other parts of the world, which means there won't be any supply disruptions or shortages. Alright, let's mention another point here. Specifically, regarding China's investigations into the semiconductor supply chain, especially those involving American companies, such as investigations into unfair competition, antitrust, which is anti-monopoly, and anti-dumping, back on October 10th, for instance. Qualcomm, which is an American chip company, was once investigated by China because of an acquisition case, specifically the acquisition of Autotalks. This triggered an antitrust investigation, mainly because Qualcomm did not file a declaration at the time. And since they completed the acquisition without any communication with the State Administration for Market Regulation, they ended up being investigated. Now, let's take a look at Qualcomm's stock price at that time. If we cover up the newest data on the far right, we can see that on October 10th, which was the day of the event, the market seemed to be a bit panicked. It broke through both the medium and short-term moving averages, so it looked like the situation was pretty dire, right? But what happened afterward? And why is there this red here? As everyone knows, it's because on October 27th, they made a new announcement. Artificial Intelligence Accelerator chips. In other words, the AI200 and the AI205 are going to break into the market currently dominated by companies like NVIDIA and AMD. They're planning to enter the base price segment of the entire AI server market, and also for the computing needs of data centers. And actually, since 2026 is coming up soon, this was seen as a huge positive at the time. So if we look at the price increase back then, it went from about 170 or 180 directly up to over 200. Yeah, the surge was pretty astonishing. Of course, in the middle, there might have been some intraday profit-taking pressure that pushed the price back down. Now, the latest news is that next year, in 2026, Apple might use their own self-developed C2 chip. They might abandon or stop using Qualcomm's baseband chips. So, Qualcomm has also started to carve out its own path, because now they want to get into the data center business. So, as we just saw, their stock is still showing a bullish trend. It hasn't pulled back to a level that's really concerning. Alright, let's take another look. Since we mentioned Qualcomm, let's also look at the SOX, which is the Philadelphia Semiconductor Index. So yesterday, it went up by 0.59%, almost 0.6%. That's because, for example, Nvidia helped drive it up, and Micron also did well yesterday. With all these factors, today, a bit later, we'll take a look at the pre-market to see how things are shaping up. Will there be any impact on the semiconductor sector? Well, yesterday, among the major indices, the Dow Jones was relatively weaker, so it dropped and corrected by about 0.48%. But if we take a look and compare it to the Dow Jones, the semiconductor sector has actually seen a pretty impressive increase since April this year. In other words, compared to the S&P or the Dow Jones, the gains have been quite remarkable. Same for the Nasdaq. Let's look. If we use a round number, about 4,000 points as the low for the semiconductor index, and now it's about 7,200, that's a difference of 3,200 points, or roughly 80%. So, seen this way, it's already up about 80% from the low. So any kind of pullback, whether it's 3%, 5%, or even 10%, actually isn't that serious. But let's take another look. Yesterday the broader market was relatively weak, right? And today, if we look at the pre-market just now. But among the three major indexes, if we look at the futures, the Dow Jones is actually the more stable one. So you can see that today the Dow might be the one leading and supporting the market, playing a key role among the major indexes. Pay attention to that. And if there are some large cap stocks within the Dow components, those are also worth keeping an eye on. As for the S&P, it also had a slight increase of 0.17% yesterday. The Nasdaq 100 was similar. It was at a relatively high level yesterday, and in terms of performance, it was a bit better than the Dow. Looking at the chart, it also looks pretty good. It went up by 0.44%. Early this morning, Palantir, which we mentioned yesterday as possibly being related to AI and also having collaborations in the defense sector. We pulled up a longer-term chart here, and since the beginning of this year, its stock has actually risen by more than 160%. But because the earnings report came out early this morning, investors, analysts, and some institutions are concerned about its valuation. Let's take a look at this. Good morning, everyone. Actually, the company raised its earnings guidance, and for the latest quarter, quarter 3, the revenue was $1.18 billion, which is a year-over-year increase of 63%. That's actually pretty good. And this is also higher than the market's expected $1.09 billion. As for EPS, it was 20 cents, which is also above the original market expectation of 17 cents. However, the situation afterward wasn't great. The stock dropped about 4 or 5%. Just before the market opened, I saw it was also down about 6 or 7%. So, is it really as these European and American institutions have analyzed? The so-called concern is that, actually, its performance is quite good. However, there are two things everyone should pay attention to. First, is it becoming overly concentrated in its development in the US, while its international expansion is somewhat slower? That's the first point. And of course, we also have to consider that now because the US government shutdown, right, whether it will be able to secure new orders or maintain its current growth rate going forward, and whether it can keep up the rapid pace it had in the past. These are things we need to watch out for. Then, there are also some analysts who have raised concerns about its valuation. If we compare its current earnings performance, the price-to-earnings ratio, depending on the data source, ranges from over 80 times to around 100 times. Given the current valuation, it's definitely something to pay attention to. If, after its new business initiatives, its revenue continues to rise significantly, then its earnings could also improve. If it can achieve rapid growth, then perhaps the price-to-earnings ratio could come down more quickly. In other words, if we look at this chart here, if we do the same thing and cover up the right side, right? If you cover it up, you'll see that it's actually quite normal for the stock to pull back after hitting a new high. It's the same here. Looking at it from this point, it's also normal for it to pull back after reaching a high. Within a week or two, it's the same. After hitting a new high, it pulls back. If you cover the right side and recall what it was like then, you'll see it's normal for it to pull back after a high. So after a week or two of pulling back, it consolidates again. But then, what happened next? It went up again, right? That's because it's truly a pretty unique company. Okay, let's take a look at some important financial events and economic data. ISM released data yesterday. Due to a drop in output, the manufacturing index fell by 0.4. Right now, it's at 48.7. And for several consecutive months, it's been below the 50-point threshold. So, the overall atmosphere in the manufacturing sector hasn't fully improved yet. Clearly, the idea of Made in America or bringing manufacturing back to the US is still just that, an idea. Can Trump's vision really be achieved? As we can see, even after 10 months, things haven't moved that quickly. In fact, the American manufacturing sector is still showing signs of weakness and sluggishness. On Wednesday, there will be the ATV report, which, since it's from the private sector, can serve as a reference for the Fed. Next is Friday. If the government shutdown continues, there may not be data for non-farm payrolls. So, the University of Michigan's Friday data, especially on inflation expectations, is something everyone should watch as a reference. Alright, so just now we already talked about PLT in the previous segment. Regarding valuation issues, what we need to pay attention to going forward is whether their earnings can accelerate further, which would allow the PE ratio to be revised downward, or whether some stock price adjustments will take place, so that the P/E ratio can return to a more reasonable or generally acceptable range. Alright, so in the next few days we have AMD, Uber, McDonald's, AppLovin, Qualcomm, which we just mentioned, and on the 6th, there might be some ARM-related news coming out. It seems that on the 7th, there's also a company like 15MP whose earnings report will be released one after another, so please stay tuned for that. Now, as for US stocks, which individual stocks are up or down in pre-market trading? As we just mentioned, let's take a quick look together. Because the three major index futures actually started to weaken as soon as the Asian session began today. By the time it got to the European session, around 5 o'clock, that was when it hit a low point. Later on, there was a bit of a rebound, with some buying support coming in. So what should we pay attention to today? Besides already knowing that the pre-market tier is a bit on the weak side, which other companies should we keep an eye on? For example, memory stocks. Yesterday they were up more than 4%, but today they pulled back and are down more than 3%. And then there's WDC, which is also a company related to memory and hard drives. As for Dell, it was up yesterday but has turned to a decline today. I also checked the performance of the Magnificent Seven. Right before the live broadcast, I looked at the pre-market numbers and noticed that some of them had pre-market drops ranging from about 0.5% to around 2.5 or 2.6%. Among them, there are two that are particularly worth paying attention to. That's my answer. As for the answer, the pre-market drop is about 1.8%. Now, Tesla is another stock that's relatively weak, with a pre-market drop of 2.5%. So everyone should keep an eye on that. Let's take another look here. Just now, there was a stock with a heavier drop, ADM. Why did it drop so much? This company mainly processes oils, corn, oats, barley, wheat, and other agricultural products. They even produce animal feed. So basically, it's a company related to food and grain production. But the reason for the drop is that it lowered its full-year earnings per share forecast, or EPS. We can see that originally, it was 4. The company lowered it to between 3.25 and 3.5, which is also below the consensus estimate of 3.76 from some analyst institutions on Bloomberg. So, its pre-market performance was relatively weak. Looking at it again, it dropped by about 5%. Alright, now let's look at the gainers. The one that went up is HSIC. As for Henry Schein, the company announced adjusted earnings per share of $1.38, which is actually close to market expectations. The forecast was $1.28 per share. And their third quarter revenue also beat market expectations, $3.34 billion compared to the expected $3.28 billion. The company mainly deals in medical supplies, healthcare, and dental-related products. They even released full-year guidance, which is above expectations. Even though this happened in pre-market trading, I know that what people are actually more concerned about is, well, as I just mentioned, before the market opens, some of the main indicators and individual stocks might weaken a bit, right? Like I just talked about the Magnificent Seven, and among these seven, and I just checked, none of them are up. If, say, among the Magnificent Seven, 3 were up and 4 were down, then maybe things would be a bit more balanced, right? You might feel like the market is just slightly weak. But since the main ones, the big tech giants, especially, for example, Nvidia, which has a high weighting in the index, is down about 1.8% or 1.7%, then everyone really needs to keep an eye on this. The index could see a bigger pullback and more volatility today. So what can we do? If we have some long positions or holdings in our portfolio, we could consider reducing them a bit. Why? The main reason is not just to have more cash on hand, but it also reduces the emotional sensitivity in such situations. In the future, if there really is, say, a 5% or 10% pullback, we'll still have some cash on hand to respond. If we're optimistic in the long run, we can use that cash to buy on the dips at all those buy points. And if not, alright, but why? Why do I say this? If today we just reduce our positions a bit, let's say we lower our holdings, whether it's by a third or a quarter, so about 25% or 33%, just trim them down a little, depending on each person's investment philosophy and trading logic. Some people prefer to hold their investment portfolio for the long term. But that's fine too, there's no problem with that, because it's a more conservative approach. The US stock market has been rising recently, and if you look at the data from this year and even the past 2 or 3 years, the historical data also shows that US stocks have been trending upward in the long term. But if you don't want to experience some short-term pullbacks, you can consider adjusting your risk preferences, and you should even raise your awareness of risk. Alright, I'm glad that today's Equity Goodnight session ends here. I hope that everyone can turn misfortune into blessing in your investments. When you make your trades, may you attract good fortune and avoid misfortune, and may everything go smoothly. While you invest at your own pace, remember to keep risk control in mind. Alright, that's all for today's Equity Goodnight. See you tomorrow, bye-bye.
Our company has no improper financial interests in the individual securities recommended or analyzed. The information in this program is for reference only. Investors should make independent judgments, evaluate carefully, and bear their own investment risks. If you don't want to miss the latest market updates, be sure to turn on the notification bell and hit subscribe. In addition, we have plenty of great video content on both Facebook and YouTube. Don't miss out. In our group, we share in-depth explanations of global financial events with you every day.